I'm Rafia Hassan, Chief Investment Officer of Wipfli Financial Advisors. I wanted to take a few minutes today to share some highlights on market performance in the third quarter. In the third quarter, markets built on the second quarter rebound and continued to go up despite a number of factors, including a resurgence in COVID-19 cases, renewed lockdown restrictions in some areas, a shaky domestic unemployment picture, the upcoming presidential election, and last but not least, a lot of uncertainty around the passage of a second stimulus bill. So let's take a look at returns across major asset classes in the third quarter. So looking at equity markets, US stocks were up 9.2% in the quarter and had a strong recovery. Within the US stock market, much of the recovery was actually concentrated in the top 5 stocks, which have become a larger part of the overall market. On the international front, international developed stocks were up 4.8%. And then within emerging markets, we saw the best returns across the equity asset classes, with emerging market stocks up 9.6%. Some of the best performing emerging market countries during the third quarter were China, India, and South Korea. China in particular was supported by a further rebound in both manufacturing and service activity. Looking at fixed income, the bond market overall experienced positive performance during the risk-on environment in the third quarter. If you look at the US bond market, and in this chart, what we're looking at is investment grade bonds, those were up 0.6%. Overall, we saw credit spreads, which are the difference in yield between a high quality bond and a low quality bond, continue to narrow in the third quarter. And when yields go down, bond prices go up. So we saw the lower quality segments of the bond market outperform the higher quality segments. And that's consistent with what you're seeing within emerging market bonds, which performed well and were up 2.3% for the quarter. Another factor that helped emerging market bonds was rising commodity prices, because many emerging market economies are actually heavily dependent on the production of various commodities. So what's next? Even though COVID-19 and the implications of the pandemic have created a ton of anxiety for investors, you could say the approaching US presidential election also adds an additional layer of uncertainty for sure. When you look at market returns through past election cycles, the data shows that elections have not historically had a material impact on financial markets. And even though policy differences always exist between political candidates and parties, markets tend to reward long-term investors who stay invested through all types of political climates. As always, if you have any questions, feel free to reach us at wipflifinancial.com.